Anyone with some money in their pocket or in their bank account who's thinking, what should I do with this? This video is for you because what I'm about to tell you genuinely shook me. Last week, I opened my banking app and just froze. I couldn't believe my eyes. I have $10,000 in my account. The interest rate is 0.5%. A full year passed, and what I earned was just $50. $50! That's not even enough for lunch. I put my phone down on the table and sat there for a long time. Then I asked myself, what have I been doing all these years? Because everyone around me was talking about investing. Stocks, index funds, compound growth, all that. And up until that day, I was actually proud of myself, telling myself, look how disciplined and frugal I am. Then it suddenly hit me. Just saving money doesn't make you rich. It can actually leave you behind. This really kept me up that night. Honestly, I couldn't sleep. And I'm sharing this with you right in that moment because I'm sure a lot of us are going through the same thing right now. First, get this firmly in your head. Saving protects your money, investing grows it. They're completely different things. I mixed these up for years. Nobody ever explained this to me. Let's look at the numbers. Because the first time I saw them, my stomach dropped, honestly. Leave $10,000 in the bank at 1% interest. After a year, it's $10,100. Put that same money into investments earning an average of 10% a year, and after 1 year, it's $11,000. The difference looks small at first. You think, hey, who cares? But the real story shows up over time. After 20 years, the money in the bank is $12,200. The money invested is about $67,000. We started with the same amount, but the results aren't even in the same universe. And I think the most striking part is this. The real gap isn't between savers and spenders. The real gap is between savers and investors. So why can't most of us take this step? It's not about the math, it's about our heads. Saving feels safe. You can see the money. It sits there steady. It doesn't suddenly drop 5% on a Tuesday afternoon. But investing keeps moving. And that movement scares people. I was scared too. Honestly, I still get scared sometimes. I won't hide that. Now maybe you're thinking, okay, but I don't want to lose what I have. You're totally right. I thought exactly the same thing. That's why this shift shouldn't happen all at once. It should happen step by step. Let's go through these steps together, like we're just sitting side by side talking. No rush at all. Step 1. Have a real emergency fund. Before putting a single dollar into investments, set aside cash covering 3 to 6 months of expenses. This money isn't for investing. It's for surprises like job loss, health issues, car trouble. Because the main reason people panic sell investments is that they end up needing that money at exactly the wrong time. Your emergency fund protects your investments from your own life. Step 2. Mentally separate saving and investing. Picture 2 boxes. One is safety money, the other is growth money. Safety money sits still, never moves. Growth money fluctuates because its job is to grow. The moment you make this distinction in your head, that inner tension drops a lot. I guarantee it. I've seen it in myself. Step 3. Start small. Most people think investing requires thousands of dollars. No. A lot of platforms let you start with $50 or $100. The point here isn't immediate big returns. It's building a habit. Because habit matters more than timing. Step 4. Focus on simple investments. The most common mistake beginners make is jumping straight into complicated stuff. Day trading, options, crypto speculation. But the truth is, the simplest investments usually outperform the complicated ones. Take index funds, for example. Instead of betting on one company, you become a part owner of hundreds of companies at once. More diversification, less risk, long-term growth. Simple and effective. Even some of the most respected names in investing have told small investors the same thing for years: low-cost index funds. Now, let's get to the most important part. I think this is the heart of the whole video. Please don't skip this. The most powerful investment strategy is actually incredibly boring: investing consistently. Think about it this way: invest $300 a month. The market averages 8% a year. After 25 years, you'd have around $285,000. But here's the wild part. Out of your own pocket, you only put in $90,000. The remaining $195,000 comes purely from growth. I remember staring at that number for a long time the first time I saw it. I still find it hard to believe sometimes. But of course, that's where your head gets in the way again. Investing feels uncomfortable at first. Markets drop, the news gets dramatic, everyone panics. And that's exactly where discipline separates an average person from a real investor. Here's an analogy I like to use. Saving is like keeping seeds in a jar. You're protecting them, but nothing grows. Investing is like planting those seeds in the ground. At first, it looks messy, like nothing's happening. But over time, everything grows. And one day you look around and realize you have something far bigger than the seeds you started with. Maybe you're thinking now, but what if I start and the market crashes? Great question. I asked myself the exact same thing. But here's the thing. Market crashes are normal. They've happened dozens of times throughout history, and they've always passed. What matters is this: long-term investors actually come out ahead even through these downturns. Because when the market drops, the money you invest each month buys more shares at a lower price. And when the market recovers, that turns into extra returns for you. That's why experienced investors stay calm during volatility. They're not thinking in days, they're thinking in decades. Let's put it all together. 1. Build a 3 to 6 month emergency fund. 2. Mentally split your money into safety money and growth money. 3. Start investing small amounts but consistently. 4. Focus on simple long-term things like index funds. 5. Stay disciplined and give compound growth time to work. Because here's the truth: saving gives you security, investing gives you freedom. The sooner you combine the two, the stronger your future becomes. Where are you right now? Still in the saving phase, or have you already started investing? Let me know in the comments, because the day you make that shift, your money actually starts working for you.